Well, let's start with the things that appear to be the same at the moment, just so that to get some consistency. I think about 18 months ago, or maybe 12 months ago, we spoke about the Australian dollar going to 51, iron ore going to 31, and oil going to $41. Well, those trends had already started to get established. They were early days, and that trend seems to have continued. So clearly oil has continued trending down, and we come into this new period with oil heading lower. We have had iron ore trend down, and for in all intents and purposes is still trending lower. And we've had the Australian dollar go from $1.08, $1.10 to 70, 71 cents. Now clearly there's going to be micro movements in that trend. The Australian dollar could go from 68 to 71 or 71 to 74. The trend from $1.10 to 51 still appears intact, so which is the trend is down. So these are longer term trends of a lower Australian dollar, lower energy prices and lower resource prices are intact. And of course, this is quite a big part of the Australian economy, and these trends actually feed off each other. If you're a global fund manager and you're selling resource companies, you're also getting rid of your Australian dollars and repatriating them back to where your initial investment was made from. So these trends are in place. Then you've got some unusual and interesting trends emerging, which are, we've had another trend in place for nearly 30 years now, which is falling interest rates. For Australia, nearly 30 years now. And there's a concept that Australian interest rates could fall again or could stabilise, whilst we've had US interest rates go up. That puts further pressure on the Australian dollar. If they have high interest rates and we have low, the US dollar becomes even more attractive. We also then have the fact that if interest rates in America do go up, that's a bit of a headwind for the equities market in Australia. And I think that's this volatility that you're seeing now. If there's ever going to be a change in trend, or there's a worry that there's going to be a change in trend, you get volatility. Volatility is a reflection of a period in time when people can't agree on whether the market should go up or down. So at the moment, people can't resolve in their minds, we would say, whether interest rates in America are going to continue to go up and create headwinds for the equities market, or whether they're going to stabilise, and we've got a benign environment where actually equities are the cheapest asset class out there still. Yes, look, I think to the extent that those trends are in place, they appear not to have changed in our minds at this stage. What potentially has changed, and of course this is the double-edged sword with potential interest rate stabilisation. If interest rates have been falling for 30 years and they stop falling, or even, I mean, the suggestion is now there that interest rates in Australia will go up, but if they were even to tweak up slightly, all those assets that get measured against an interest rate are highly sensitive to price changes. For example, house prices, commercial property, equities, in particular interest rate sensitive stocks, banks, fund managers, diversified financial companies. And of course, that's what you've seen in the last month or two. You've seen a huge gyration and volatility in that style of stock. For example, the big four banks in Australia, the fund managers, the listed fund managers in Australia, the Macquarie banks of the world, the Henderson asset managers. These stocks have displayed significant volatility. It's fair to say at this stage the trends are still in place. Henderson's come from $1.80 to about $5 or $6. Macquarie Bank's come from $25 to around $75. The one where potentially the trend is not in place are the major banks, which are now experiencing significantly reduced earnings growth. It's fair to say that the dividend yields are supporting the share prices, although that support doesn't seem that strong because the equities have actually come off 20%.